I went over 127 extremely profitable traders and found a very unique distinction for traders who consistently made money every single month. And these trades and these traders have an extremely interesting commonality. In this video, I'm going to walk through exactly what that commonality is, and more importantly, how you can use it to create more wealth, more cash flow for you and your family. I have back traded the entire market from inception over 75 times. That means I've gone through World War I, World War II, Vietnam, the Great Depression, 9/11, all the markets, all the waves, all the patterns. So the very first thing that I noticed among my very profitable traders is the non-directional trade. So what does it mean to non-directionally trade? It's a very interesting concept. Well, in the markets, you can actually get paid to decide where the market should not go. I'm going to dive into a screen share and give you an example of what I mean by that. The first stock that I'm going to pull up is a company called Palantir. Palantir has been around on the markets for about 5 years now. Came out in 2020. And this is a data company specifically that works a lot with government contracts and government data collection and AI. And what you're going to notice here as I zoom in is Palantir had a really massive, huge run up over a beautiful period of time. From August to about March, the stock itself increased in value 359%. Now, that's a direction. You know that stock was going up. You had an incredible increase in value. And then the market had a very normal, very large correction and pullback where Palantir retraced about 35% of its overall move. When a stock pulls back, this is a very interesting practice that many people become afraid by. In fact, the most common thing that I've seen people mess up on is not buying assets as they pull back, but buying assets as they go higher. A non-directional trade is actually a trade where someone says, I don't think the market's going to do this, so therefore I'm going to be able to put on a position and I'm going to win using non-direction bias. Here's what it looks like. When Palantir had a 35% pullback, I'm going to draw a green circle. And right around here in this green circle, you could have said very easily, we had a huge run up, we've had a huge pullback, we are interacting with some very large moving averages. I am going to sell a stock market position that is an insurance position where you are insuring someone who is scared. You are selling to them insurance. If they buy the insurance from you, they are trying to protect their asset from going down. If you sell them the insurance, you get paid cash up front. You could have sat down and said, I don't believe that Palantir is going to go to 50. But if it does go to 50, I'm still going to make money. Because you're going to end up buying the stock at 50 when the stock was previously at $120. This is something called a put sale. And with absolutely zero analysis, you can win on selling puts about 67% of the time because these are non-directional based strategies. As long as the stock does not go straight down, the position works just fine. If it goes sideways, if it goes up a lot, if it goes up a little, if it goes down a little bit, you're going to win 67% of the time. Now, doing some overall analysis, coming up with where, when, how, why, all the numbers, you can start winning on put sales over 98% of the time, and you'll have a P&L that looks a lot like this gentleman's right here. This is a gentleman that is working my program right now, and he's been doing a lot of put sales. So him selling these puts, you'll notice, look at all this green. You have one red position, and every other position on the entire screen is green. And that's because he is selling non-directional strategies. It's an incredible, remarkable way to generate consistent income. Okay, number two. The second most intriguing commonality that I noticed among amazing profitable traders is they are playing volatile instruments on large companies. So when I say volatile instruments on large companies, what I mean is not playing penny stocks, not interacting with companies that have very small market capitalization, but you can still have huge swings on very large companies, companies that are in the billions and billions of dollars. let's do a quick example. Pinterest. If I pull up the market cap on Pinterest, I'm going to use a screener called FinViz. And the market capitalization on Pinterest right now is 19.7 billion. Massive. If I zoom out here on a little bit of a larger time frame, what you're actually going to notice is Pinterest has stayed within a very interesting trading range for about 3 years. This trading range is between $20 and $30, buying it at 20, selling it at 30. Now again, a company in the magnitude and the size of Pinterest is not going anywhere overnight. They're not going to disappear. They're not cooking their books. It's a humongous company with a massive market capitalization, but it's crazy volatile. And really, this is a belief change that most people aren't aware of. It's a mindset shift that this is actually available on larger companies. Huge, amazing, frequent ups and downs. Really beautiful volatility. These moves right here on Pinterest, these fluctuations in price, these are 20 to 30% every 2 or 3 months, up and down. And you all know that you can play the markets up and down, but most importantly, if you don't want to bet on a direction like Pinterest, you can actually see this going sideways. You have the ability to play non-directional strategies on, again, more volatile, but still humongous companies. Another very interesting example is NVIDIA. NVIDIA is actually the second largest market capitalization company on earth right now. And if we zoom out, I'm going to show you again how volatile this particular asset class is. If we're looking here, I'm going to pull up a price range meter. And this particular move, that's a 72% move on NVIDIA. Then, just a few weeks later, you had a 44% move. And again, I'm only going to be looking at right now just the bullish trades. Coming over here, I'll put my magical indicators back on. I really love these long-term averages. This is when the China news came out, so we're going to drop this down. Trading from the 200 to the 100, that's another 18% move, right? I'm going to copy this again, clone this, move it over here. And what we're looking at off of this beautiful bounce is, again, another 30% move. So these are 4 moves on NVIDIA, the second largest company in the world. Over the last 17 calendar months, you have a 72% growth, a 44% growth, a 30% growth, and an 18% growth. Not really catching the exact tops and the exact bottoms, but just kind of buying and selling the range. So it's a mindset shift to be aware that you can still interact with these huge companies that are still extremely volatile. All right. The third thing that I noticed reviewing hundreds of profitable trades over hundreds of profitable traders is options. When traders understand how to use options, you can actually get paid to create an unlosable position. Let me pop over here to Tesla really fast. And on Tesla, what we're going to do is we're going to notice a very fascinating phenomenon. Again, referring to the extreme volatile nature of stocks, still on extremely large, humongous companies. Tesla being the 7th largest company on earth, still has extremely huge price swings. From October to December, it went up 100%. And then it went down 50%. And then from March to mid-April, it went up 26% twice. 2 separate occasions. That is a humongous amount of momentum and volatility. But if you are a net buyer on Tesla, and let's say you're a net buyer somewhere in the red circle here. If you bought Tesla in the red circle, you were able to capitalize and protect yourself even though Tesla had downswings. You were able to protect yourself by implementing option strategies. The traders that I work with that really crush it every single month, and they have certainty, they have no fear, they have no failing months, is they're using options to leverage their positions, because we all know that stocks are going to go up and down. And we all know that buy and hold does work. But if you are buying and holding a stock, you're not creating cash flow. And cash flow is how you live a more expansive, more abundant, and more prosperous life. So if you can use options in combination with your stock to create cash flow opportunities, again, in this situation, if you are a Tesla shareholder, you have the ability to do what's called a covered call. A covered call is when you bring in income by selling a call option, and you then protect your downside by buying a put option. These two strategies can actually totally protect and mitigate any downside price action if you are buying the insurance policy, aka the put option, above where you bought the stock. Let me factor that in one more time for you, because this is a really important concept to notice. If I go back into October, and if you bought Tesla around here, somewhere in the red circle, Tesla increases very nicely in value, and as Tesla gets higher, right around here, you start implementing a collar strategy. So again, you are selling call options, which bring in income. So I'll say income. And then you use that income to then buy an insurance policy. I'm gonna draw an orange line. The orange line, again, is now representing the insurance policy. The insurance policy allows you to sell your stock at the price that you bought the insurance policy at. And again, you're gonna notice this visually, the insurance is well above where you actually bought the stock, which means you are able to sell the stock higher than you bought it for. And since you were selling call options, which bring in income, you're using that income to buy the insurance policy, you're going to be able to still get what's called a net credit, also known as cash flow, in order to do this trade. And as Tesla goes down, which we can all see that it did, and you're going to continue to hold Tesla because you don't want to sell it, you want to buy and hold, you want to be a buy and hold investor, you are still able to create cash flow. And I think that is a fantastic way to be able to interact with your portfolio, with your retirement, and with your money. All right, last but not least, the massive commonality that traders who are experiencing extreme success, they have studied the charts. They have put in the time and the energy, just like my friend here, who created over $154,000 of profit in a day. His account value is $262,000. You can see a 1 month change of $202,000. This particular gentleman is actively trading the markets. When you spend time, energy, and effort on one of the most incredible opportunities that will ever face humanity, is interacting with liquid markets, because the opportunities are infinite. There are more money-making opportunities every day than we can take advantage of in a lifetime. So we don't need all of them, we need just some of them. And these option strategies, the market volatility, the big names, the big companies, the things I'm going over right now, anyone can do on any company at any given time. Once you understand what you're doing, and most importantly, how to do it, when you spend time on the charts, you start seeing, feeling, noticing, and understanding certain patterns, certain emotions, how certain stocks move. Like HIMS, for example, Him and Her Health. You're going to see a really, really fascinating move up, extremely big move down. We came in contact with, again, these really, really huge moving averages, which is called the 100 and 200 something moving average. And if I zoom in, again, this is where studying the charts becomes very helpful. You'll notice this big red volume bar right here. This big red volume bar right here represents a lot of what's called short sellers. Short sellers are people that come in to sell the stock short, hoping to make money as it goes down. In this exact situation, you can actually look at the chart, again, spending time, energy, and effort being in front of this market and these opportunities. These short sellers are going to get squeezed out if the stock goes higher. And we can see that the stock did in fact go higher, right? We broke above the high of all of that bear volume candle, which created a short squeeze. A short squeeze is when bear traders have to buy to cover their position. When you have tons of people flooding the markets to buy to cover a losing position, all of that buying is increased demand, which causes the stock price to do what? Go up. So the bears are getting squeezed, the short sellers are buying to cover, the stock is actually going higher, which allows you to profit in these situations. And here's a bonus. Once you really understand non-directional trading, once you understand options, and once you understand how to leverage these positions, you actually are able to create extremely amazing and safe risk protocol trade setups, which allow you to enter the markets with bigger size. Most common, I see people put $10,000 into the market, hoping it turns into $1 million, and that's it. But in reality, the chance of that happening is almost zero. What is a guarantee is if you put money in consistently and often, understand strategies, and really put bigger positions on with proper risk mitigation, that, my friends, is how you can create generational wealth. Thank you so much for watching this content. I hope it was helpful and beneficial. If you have any questions, post in the comment section below. I'm happy to help you out on your financial journey.